Hello dear students, welcome to Devika's Commerce and Management Academy. In the previous class, you got an understanding about what is capital budgeting, methods of calculation of capital budgeting, traditional methods, modern methods, undiscounted, discounted we have seen. So today we'll enter into the practical problems of undiscounted. Undiscounted total 2 methods are there. It's a recap. Okay, 2 methods are there. What are those methods? One is payback period method, second one is ARR, accounting rate of return or average rate of return. So out of this payback period and ARR, we'll see payback period method today. ARR next class, but we'll go in depth. You'll get a very good understanding. Just focus for 5 minutes, you'll understand. Payback period method means when I'm investing suppose say 1 crore rupee. Example, where should I write? Here I'll write. If I am investing 1 crore rupee, in how many years I am going to get back my 1 crore rupee? In how many years? That is payback period method. So for this, what is required is here annual inflow. Annually how much I am expecting? I am investing 1 crore, okay. But every year how much is the inflow I am getting? How much income I am getting it? Say for example 25 lakh each year I am expecting. 25 lakh. 25 lakh means in how many years I am going to get back my amount, my investment? First year is 25 lakh. Second year 25 lakh. Means second year it will be every year 25. 25. 4 years. 4 years I am getting back my 1 crore. So payback period is here 4 years. You can say payback period is 4 years. It means if I invest 1 crore rupee, every year I am getting 25 lakh rupees. Means in 4 years I am going to get back my 1 crore rupee. That is 4 years is the payback period. This is one alternative. Let me see the another alternative. Same investment 1 crore I am investing. In another alternative, suppose say first year I am getting 25 lakh, second year getting 50 lakh, and also say, third year or otherwise you okay, and third year also I am getting 50 lakh. It means 1 year, 2 years 75 lakh is over, and third year only I wanted to take 25 lakh only to get my 1 crore rupee. It means payback period is here 2.5 years. There it was taking 4 years, but here it's taking 2.5 years only. This is project 1. This is project 2. If I invest 1 crore, project 1 is taking 4 years. If I invest same amount, but project 2 is giving me 2.5 years. In 2.5 years only I am going to get back my project. Get back my investment, get back my investment of 1 crore. Which project do you prefer? As a layman also you can give the answer which one is going to give you good result. Definitely project B, because in 2.5 years I am going to get back my investment. That is better. Why should I wait for 4 years? So much important. Payback period. In how many years I am going to get back? This we are discussing in this payback period method. Okay? Clear? Where is my duster? So payback period, how we can calculate it? There are 2 methods. One is when the cash inflows are even. Even cash inflows means same amount is given every year. That's even. When the cash inflows are uneven, not equal. Both the cases we'll see. Okay. First case, where the cash inflows are even, means same amount is given. As I said, 1 lakh, say 1 crore I am investing. Every year I am getting 25 lakh only. That is cash inflows are even. Same 25 lakh only I am getting. Second case we have seen. First year 25 lakh, second year 50 lakh, like this. That is uneven, not equal. If at all cash inflows are even, means same cash inflows I am getting, as we have discussed, 25 lakh every year. In such case, there is a formula only for even case. Okay, formula is payback period is equal to cost of the project divided by annual cash inflow. Cost of the project, how much you are investing? As we have discussed, 1 crore I am investing. Okay, 1 crore is the cost of the project divided by annual cash inflows. Annually how much you are expecting? 25 lakh I am expecting. 1 crore divided by 25 lakh. What is the value? 4. Means in 4 years I am going to get back my investment. That is, payback period is 4 years. Are you getting it? We'll work out a problem and we'll see. Right now you remember the formula. Payback period is equal to investment. Cost of the investment, we say it as a cost of the project divided by annual cash inflow. Cost of the project, how much you are investing, divided by annual cash inflow. Okay. Now see the problem. The cost of a project is 1 lakh. My investment is 1 lakh. The cash inflows for the next 6 years are 25,000. Means every year I am getting 25,000. How many years? 6 years. As per our calculation, 6 years I am going to get 25,000 each year. What is the payback period for the project? When you see the problem, you have to understand that what it is. Investment is 1 lakh and my investments are 25,000 per year. How many years? 6 years. Every year same amount investing. It means this is, what is it? What it is? It is even. Okay. When cash inflows are even method. Even method means I'll use the formula. Okay. What is the formula? Payback period is equal to cost of the project divided by annual cash inflows. We'll use the formula. I am not writing the formula because already I have written. So you have to write. Coming to the solution. Directly I will work out payback period is equal to cost of the project. Cost of the project is 1 lakh divided by annual cash inflow. Annually how much I am getting? 25,000. So 25,000. It means if you deduct it, you will get 4. Means 4 years you will say. Payback period. Period means years. 4 years is the payback period. So this is my answer. Sometimes they may give you project B also. This is project A. Project B something is given. That also you have to calculate like this. Then according to that, which year is less? Which project is giving less years of payback period method? Payback period, which project is less? That you are going to recommend. As I have shown you in the previous problem. Anyway, we'll go in depth of this each and every topic in the coming classes. Right now, initial understanding you are having, right? When inflows are even, same inflow, 25,000 only every year I am investing, then go for this formula. Coming to the second method, where the cash inflows are uneven, not even. Sometimes I am getting 25,000, sometimes 35, sometimes 50. Like inflows are not equal, uneven. Then what to do? When it is given uneven, need not to use this formula. This is not going to work out. You have to prepare a table. How? We'll go through a problem. Very easy. See the problem. The cost of a project is 50,000. Cost of the project is 50,000, which has an unexpected life of 5 years. Its life is 5 years. The cash inflows for the next 5 years are this much. First year, second year, third year, fourth year and fifth year. Inflows are like this respectively. See, if you see the inflows, 24,000, 26,000, 20, 17, 16, not even. All the inflows are uneven, not equal. Then you have to prepare the table. What they are asking? Determine the payback period. Now solution. Simple. Table is also, we need only 3 columns. One is year, cash inflows, cumulative cash inflow. Cumulative cash inflow means, I think you remember median calculation in statistics. Median, quartiles, deciles, percentiles, everywhere we used to calculate cumulative. the same one only. This is as per the given data. Year will write how many years are there. Just focus 2 minutes, you will understand. How many years? 5 years, na? 1, 2, 3, 4, 5. 5 years. Cash inflows. Every year inflow you will write whatever data is given, the same one I am writing here. First year is 24,000. Second year 26,000. Third year 20,000. Fourth year 17,000. Fifth year 16,000. Okay. Now cumulative cash flow. Only one more column you are writing. These two columns are as per the given data only, and we are writing only one extra column, that is cumulative cash flow. Cumulative means first one will write as it is 24,000. Second one, how do you get? If you add these two, 24 plus 26, how much it comes? 50,000. Now 50,000 plus 20,000, 70,000. We'll be adding next year easily for the same amount. 24,000 plus 26,000, 50,000. 50,000 plus 20,000, 70,000. 70,000 plus 17,000. It comes to 87,000. 87,000 plus 16,000. 6, 6, 13, 13. And this is 9, 10. 1,03,000. Cumulative cash inflows means first year you will be getting 24,000. By second year you will be getting 50,000. By third year 70. Fourth year 87. By fifth year your inflow will be 1,03,000. Okay. But what is my investment? 50,000 only. Payback period is talking about in how many years you are going to get back your investment. My investment is 50,000. In how many years I am going to get back? 50,000 in 2 years only. By this period, I am getting back. So payback period is 50,000. Here you can write it in downside. Can you see the board? Let me check out. Yes. I'll do one thing. You can write one sentence simply because there is no formula. Table you have prepared, but what do you want to say? That you can mention it. So as per the above table, payback period is 2 years. If you want, you can extend the same sentence. Payback period is 2 years, as our investment 50,000 is covering in 2 years. That is 24,000 and 26,000. You can extend one more line also. That's all. This is about when cash inflows are even and uneven. Even means we have formula. Payback period is equal to cost of the project divided by annual cash inflows. When cash inflows are uneven, prepare simply table. What is there in the table? Given data, we have written year, cash inflows and cumulative cash inflow. Through cumulative cash inflow, you can identify 50,000 when we are covering. In the second year itself only we are covering. It means payback period is 2 years. Clear? Screenshot? Yes. No confusion at all. Next class we'll see ARR, accounting rate of return or average rate of return. Neatly as I am explaining, write a notes. Forever keep that notes with you. It will be useful for you to refer, okay, as the time comes. Whatever you study, it must be useful always in your career. It's not only for the examination point. Of course, examination point we have to score good marks, but for lifetime also practically how it is useful, that you will come to know when you prepare a clear notes. So prepare notes, and also please check out our playlist. Whatever subjects I have already covered, use it, and don't forget to share this video. Stay connected. Have a bright career. Good luck. Next class, ARR.